We at the University of the Bahamas and the Government and Public Policy Institute believe in the power of partnership, locally and globally. Partnership to facilitate high-level public policy discussions on matters of importance to our community and our world. To this end, we are delighted once again to be here today with our partner, the Global Interdependence Center, a nonprofit think tank headquartered in Philadelphia in the United States, to do just that. We have convened once again to host this one-day conference on the theme Currency, Central Banks, and Climate Change, featuring highly respected speakers from the United States, Bahamas, and the Caribbean. Throughout the day, we will address issues related to, among other things, global economic perspectives for 2025 and beyond, prospects for the US and Bahamian currencies and implications of BRICS, perspectives on monetary policy, Federal Reserve and Bahamas Central Bank perspectives, economic resiliency issues in light of climate change, continuing de-risking issues for the regional banking system, and US fiscal policy implications for the future. I believe it is no understatement to say that we are living in interesting times. Current shifts in power, policy, and possibilities across the globe, from AI to DEI, have left some hopeful, some bewildered, and others simply ambivalent. Perhaps our discussions today will provide an opportunity for new knowledge, deeper insight, and problem solving that will lead to progress. Hope springs eternal, as the saying goes. I have hope. Of course, you, our audience, will get to listen to and participate in a number of panel discussions throughout the day. So we ask you to be engaged with respect and regard for the time constraints as we move along. So I welcome you and look forward to a successful day. With that said, ladies and gentlemen, please put your hands together and welcome to this podium President Jayne Hodder.
His Excellency Joseph Curry, Senator, the Honourable Michael Halkitis, Minister of Economic Affairs, Mr. John Rowe, Governor of the Central Bank of the Bahamas, and financial leaders of the Bahamas, Dr. Patrick Harker, Governor of the Federal Reserve Bank of Philadelphia, Mr. William Kennedy, CIO, RiskBridge Advisors and Board Chair of Global Interdependence Center, Mr. Zhivago Lang, Executive Director of the Government and Public Policy Institute and Senior Policy Fellow at the University of the Bahamas, and other leaders at the University of the Bahamas, present and former board members of the University of the Bahamas. Good morning. It's my pleasure to welcome you once again to the University of the Bahamas for this public conference on climate, currency, and central banking, brought to us by the Global Interdependence Center, based in Philadelphia, and UB's Government and Public Policy Institute. Reflecting the core vision of Global Interdependence Center, today's event brings together thought leaders and decision makers from academia, public policy circles, and the business world, with a goal to promote thought exchange, dialogue, and the exploration of solutions to global challenges in finance and economics, and dare I say, climate change. UB is pleased to do so for a second year in a row for this partnership between our Government and Public Policy Institute and GIC in bringing together international experts in policymaking, central banking, industry, and the academy to explore issues and policies concerning global interdependence that impact world economics, and the quality of life. The conference today also reflects GPPI's mission to impact the good governance, prosperity, and sustainable development of the Bahamas, the Caribbean region, and beyond. In addition to the keynotes being brought by Governor Roll and Dr. Harker and speeches by Minister, sessions will address economic outlook topics of cost of living and cost of banking. A most interesting session entitled The Fed and the Flu, a session on currency issues, including examination of the Bahamian dollar, digital currencies, and future of the US dollar, and a final session on risk management during the era of climate change, which is likely to be with us for a while. These discussions are timely and important. Reflection, dialogue, and debate of worthy ideas serve to amplify good for all. My deep thanks to the organizers for staging an event from which the impact will extend beyond today and into the policies and practices which improve global economies. The University of the Bahamas welcomes you, and I wish you a very productive day. Thank you very much.
Thank you very much, Madam President. We are always delighted when our minister has the time to come and share with us to present his welcome and insights. He has immense responsibility in these challenging times as Minister of Economic Affairs. And I don't think that he could ever resist an invitation to come to the University of the Bahamas since he's a graduate of the College of the Bahamas. And so we start our invitations to him with the College of the Bahamas from which you graduated. He is an extremely astute gentleman, a financial expert in his own right, and a seasoned political leader. Please welcome with me Senator the Honourable Michael Halkitis.
Thank you very much, Mr. Lang, Executive Director, and good morning to all. The protocol has been established, but I pay respects to the President of the University and all distinguished ladies and gentlemen present. It is a pleasure to join you today as we kick off this summit to discuss the global economic landscape and the ways the Bahamas is navigating the many developments that are happening as we speak. And I must comment that in listening to Mr. Lang read out the list of topics that will be ventilated, it is indeed a very, very impressive, relevant list of subjects to be examined. And as he said, we are living in uncertain times. Geopolitical alliances are in flux, and the global economy is shifting in unprecedented ways. And I dare to say that words such as multilateralism, consensus building, and indeed, Mr. Lang, partnership seem to be going out of style. As a small island economy, it is clear that we must take the steps necessary to become more resilient, more sustainable, and more self-sufficient to thrive in these times of rapid change. We must encourage investment in emerging industries within the digital, green, and orange economies. We must develop the agriculture and fisheries sectors to lower our trade deficit and make us less sensitive to external shocks. And we must allocate the resources necessary to adapt to the triple transition of climate change, digitalization, and social equality. These three forces will spur tremendous change in coming years. And whether they hurt or help us, whether we remain competitive or fall behind, is up to us. Fortunately, ladies and gentlemen, we have a strong foundation on which to build. Last year, we brought in a record 11.2 million visitors, which broke the previous record of 9.6 million the year before. We lowered the unemployment rate to 8.7%, the lowest rate since 2008, and we expect to see that number decrease even further. We have over $10 billion in investments in the pipeline, including unprecedented investments in Grand Bahama and our family islands. And we were removed from the EU's blacklist, securing the future of our financial services industry. The economic growth we have enjoyed over successive years has not been fully enjoyed by all of our people, however, due in large part to global inflation. Fortunately, the global inflation rate is finally leveling off. This is a trend that we hope will continue amid the potential changes in tariffs that may affect many of our largest trading partners. But despite it all, we are not in a bad place as a nation, especially when you consider the impact of ongoing wars, the global pandemic, the lingering impact of the global pandemic, and catastrophic hurricanes on our economy. We have in the Bahamas demonstrated a tremendous amount of resilience, which has prompted outside observers and multilaterals like the IMF to comment on our remarkable recovery. However, we also acknowledge that there is still a lot of work left to do. Our biggest challenges are also our greatest opportunities. For example, we must now deal with the high prices caused by the rise in global inflation over several years, which has placed a strain on Bahamian families. And we are seeking to meet this challenge head on. In the short term, the electricity rate reduction is having an impact, and the VAT decrease from 10% to 5% on foods will provide some relief. In the medium term, the expansion of utility-scale solar and LNG will further decrease electricity bills as we establish new trade relationships and partners to access high-quality, affordable goods directly from source markets, cutting out the middlemen we currently rely on. This will be accompanied by policies that promote competition and prohibit anti-competitive practices, which we will bring to the public for consultation in the very near future. In the long term, we have the modernization of our transmission and distribution grid for more sustainable, efficient, and cost-effective power generation and transmission. We also have plans for a much-needed expansion of investments in agriculture as we work toward our goal of cutting our food import bill by 25%. These are some of the short, medium, and long-term measures we are taking to help families and businesses cope with high costs, with cost of living being one of several high-priority items on our agenda. We are under no illusion that the government can take on these major issues alone. In fact, the effectiveness of our private sector will be equally as critical as the actions that the government is taking. Most significantly, our capacity for innovation and growth will be determined by the development of our human capital. That is why the reforms in our educational system to include more computer classes, agricultural classes, and special needs classes, to incorporate technical and vocational certifications, and to modernize our curriculum with a focus on numeracy, literacy, and STEM skills development is so critical. Initiatives like the National Apprenticeship Program, which will provide paid training and apprenticeship for young people in high-demand areas, will also be critical in equipping our people with the skills they need to remain competitive in the labor market. Owners of small and medium-sized businesses must be empowered through the expansion of existing funding opportunities through the SBDC and other institutions, as well as through cost savings measures. In the upcoming mid-year budget, we will announce details on incentives designed specifically to attract investments in our biggest and most important industries, such as tourism, finance, technology, and energy. And of course, the University of the Bahamas has a significant role to play in educating the next generation of leaders and visionaries and producing the research and policy that will inform effective decision-making. I thank the University of the Bahamas and the Global Interdependence Center for the privilege of joining you this morning. and for taking the initiative to organize this summit and facilitate the meaningful discussions that will take place today. I look forward to seeing the powerful ideas that will emerge from this summit, and I hope that we have the opportunity to come together to build on these ideas in the near future. Our economic outlook is promising, but to live up to that promise, we must be as agile, innovative, and excellent as we know we can be when we are at our very best. Fortunately, we have a strong foundation, which will give us a strong start on the next leg of this journey. A journey I believe will lead to a brighter, more inclusive, and more prosperous future for our nation. Thank you very much and good morning.
Thank you very much, Minister. Dr. Patrick T. Harker took office on July 1st, 2015 as the 11th President and Chief Executive Officer of the Federal Reserve Bank of Philadelphia. He was reappointed for his second 5-year term effective March 1st, 2021. In this role, Harker participates on the Federal Open Market Committee, which formulates the nation's monetary policy, a policy which we in the Bahamas have an interest in, given that our dollar is pegged to that of the United States of America. I sometimes tell people like we borrow monetary policy from the US because of it. Before taking office at the Philadelphia Fed, Dr. Harker was the 26th president of the University of Delaware. He has a PhD in civil and urban engineering, an MA in economics, and an MSc and BSc in civil engineering, all from the University of Pennsylvania. I might note that he is a Philadelphia Eagles fan. Congratulations, sir. He's also a former football player. And so I want to welcome right now Dr. Harker to Keynote for us.
Well, good morning. And yes, I am wearing the Eagles tie. So just so you know, we're still celebrating. Thank you so much. Thank you. It's a real pleasure to join you at this conference. This is the last time I will be attending a Global Interdependence Center event as president and CEO of the Federal Reserve Bank of Philadelphia, given my upcoming retirement. My term ends at the end of this June. So please, and for the last time, allow me to remind you of something we do at the Fed. It's somewhat of a Fed tradition. The views I am about to express are my own and do not necessarily reflect those of anyone else and none of my colleagues throughout the Federal Reserve System or on the Federal Open Market Committee. In other words, you can't say the Fed said, you can say Pat said. That's the rule. I also want to express my real and sincere thanks to GIC and Executive Director Jill Fernito for bringing us together. It's an incredible organization, so I'm really proud to be here. I mean, GIC's work to enhance understanding of the underpinnings of the global economic conditions through convenings like this, whether we be central bankers or academics or private sector economists and experts, university leaders, this has prepared us to knowledgeably face challenges and find opportunities. And you know, as president of the Philly Fed, I feel somewhat an obligation to, at this moment, not just brag about the Eagles, I did that, check, but also to mention our fair city's most celebrated citizen, Benjamin Franklin, who is widely quoted to have said, quote, "An investment in knowledge pays the best interest," end quote. Now, he said those words before the United States was even the United States, and over a century before the Federal Reserve System was established. But leave it to good old Ben Franklin to provide timeless guidance. So I sincerely hope, I really hope that the time we're investing together now will similarly pay interest by presenting ideas on how we can together foster greater global economic opportunity, stability, and growth. And now that I've uttered the I word, I might as well get to my outlook. So where are we? As you know, 2.5 weeks ago, the FOMC voted to hold the policy interest rate steady at 4.25 to 4.5%. Even though I'm not a voting member of the committee this year, I was fully in support of that decision. And really, across the final 3 FOMC meetings of 2024, the committee decided to reduce the policy rate by a full percentage point. In doing so, we recalibrated the stance of monetary policy to a point where it remains restrictive, but less so than last summer, when the policy rate had been above 5% for more than 12 months. The recalibration has left policy, in my view, in a good position for the road ahead. Now, we need to remain data dependent, looking for underlying conditions, those conditions, and making decisions based on our best assessments of the outlook and risks. So let's pull this out, let's parse this a little bit. So look at inflation. Looking at inflation, and at PCE inflation specifically, our preferred measure, the December to December annual rate of 2.6% headline and 2.8% in the core categories, well, that largely met expectations. Now, the latest Consumer Price Index, CPI, that data for January pointed to a bit of a bump for prices. Again, I must say again, though, in January. In the last decade, CPI inflation in January has surprised to the upside 9 out of 10 times. And I think that's worth keeping in mind, that January, we need to really look at January and look and really try to factor in something that's going on with that measurement this past month. So my conjecture is that seasonal adjustments are struggling to keep up with our very fast changing economy. And we need to parse the underlying trends from the month to month noise. We need to look beyond just a single month. Now, to be sure, inflation has remained elevated and somewhat sticky over the past several months, both in overall and core figures. But that notwithstanding, I do believe that our current positioning will bring inflation back to target in the next 2 years if conditions broadly evolve as I expect. Now, if we were to look at monetary policy as we would a gauge on our car dashboards, the needle would still be pointing to the restrictive side, albeit less so than it was 5 or more months ago. We need to continue letting monetary policy do its work and letting the data roll in. But indeed, there are also upside risks which we cannot easily dismiss, which I'll touch on in a moment. So let's turn to labor markets. Labor markets have largely returned to balance in the United States. Last year ended with a stellar report for job growth, and this year started pretty well too, so the signs indicate hiring has continued at a decent clip. So, I am concerned when I hear or read observers referring to the job numbers as representing a slowdown in hiring. You hear this a lot. Well, yes, it is slower when compared to the torrid pace of the growth in the months coming out of the pandemic. Some job seekers may be taking longer today to find new employment than they had, say, in 2022, but the numbers imply that persistence pays off and workers are finding jobs. And in an overall historic context, I'd suggest that the labor market has recalibrated to where it was roughly in 2018, 2019. And I don't know many of us who would argue that the labor market was in poor shape then. In fact, quite the opposite. Now, surely it is our nature to want to parse out month-over-month fluctuations. That's what we do. But as I said earlier, I am more interested in trends gleaned by looking over a longer time horizon than I am from noise from a single report. In the labor picture, one thing I see is average monthly employment creation over the entire course of 2024 largely mirrored the pace of growth in the years immediately preceding the pandemic. The unemployment rate remains low and is about in line with my projections. Meanwhile, GDP growth has similarly continued apace, with 2024 proving the American economy more resilient than some forecasts had predicted. And while fourth quarter growth came in lower than the previous quarter, the economy stood firm, especially in the face of an October highlighted by a major labor strike and multiple natural disasters. And yet again, consumers came in with another strong quarter of spending. The resilient consumer, that's really the story here. Even if there are some clouds in the distance that we should not ignore, and I want to touch on that as well in a minute. I would also point to the Philadelphia Fed's own Arroba-Diebold-Scotty Business Conditions Index, which measures a slew of high-frequency indicators. This index has been moving upwards since October and has been tracking in generally positive territory since late November. As we started the year, the Philly Fed's January Manufacturing Business Outlook Survey, or what we call MBOS, registered its biggest jump in current activity in nearly 4 years. Now, obviously, 1 month does not a trend make, so I will certainly be looking at the release of this month's MBOS later this week for greater guidance. All in all, the current data paints a picture of an American economy that continues to function from a position of strength. Now look, inflation is still elevated, and be clear, the mission is not yet accomplished. But I am encouraged by both the longer view, which clearly points to disinflation in the last 2 years, and the zoomed-in view, seeing key categories like shelter moving in the right direction, albeit slowly. GDP and production remain resilient, labor is largely in balance, and these are reason enough, in my mind, for holding the policy rate steady. And while I will not commit to a specific timetable, I remain optimistic that inflation will continue a downward path and the policy rate will be able to decline over the longer run. This does not mean, though, there are not areas of potential concern. In fact, the only thing I can say with any certainty is that there are many uncertainties. That's the world we face. Upside risk to inflation and downside risk to employment remain in balance. With regard to inflation, we simply do not yet know what, if any, impacts we may see from new economic policies and priorities, whether they be domestic or foreign in nature, and we just don't know their impact. As a reminder, and this is really important, it is not the Fed's role to devise, let alone comment upon any such policies. That's not our mission. Our role is to use the monetary policy tools at our disposal to ensure we can meet our dual mandate within those chosen frameworks. And there are risks. There are risks from entirely non-governmental happenings as well, such as the impact that avian flu may have not just on the prices of eggs, but also on the products which rely on eggs for production. Everybody's talking about eggs suddenly in America. Moreover, I must acknowledge that as far as I can stand here and say that the American economy is operating from a position of overall strength, and I think that's true on average, there are many, many families and businesses for whom that pronouncement rings somewhat hollow. They're not seeing it. In fact, I see some of the basis for their sentiment in the data we collect at the Philly Fed. For example, the Philly Fed has access to a long data series looking at consumer credit. In the aggregate, overall credit card delinquency rates have been moving sideways. But our staff has found an increasing practice of consumers making only minimum payment toward their credit card balances, with more than 1 in 9 active accounts now making just the minimum monthly payment. Now, certainly, not every minimum payment will become a missed payment. Not every account is going to fall into the hole of delinquency. Some consumers surely will cure their accounts and clear their balances. But the data show the increasing stress that many consumers are facing in managing to keep their heads above a financial waterline. Moreover, our Consumer Finance Institute recently conducted a survey in which it asked individuals expressly about the cost of their home or renters' health and auto insurance premiums. The CFI report of the survey, it's not yet final, but I do want to share some of the insights in that report with regard to homeowners insurance specifically. First, insurance holders reported increases in their premiums over the prior year at a higher rate than any other insurance product. Moreover, More of them described the increase as significant. Second, homeowners were much more likely to have taken on a higher deductible as a means of managing the increase in premiums. In other words, they're willing to take financial risk in the future, literally betting the house, in order to improve their liquidity position right now. Now, when it comes to the inflation indices, whether you are looking at CPI or PCE, insurance costs may not carry enormous weight within the overall equations. They don't. But around kitchen tables, they do. And especially among households which are already feeling financial stress. And as GDP has been buoyed by the resilience of the consumer spending, it does raise a concern as to how long this appetite for spending will persist. Now, at the moment, these are still just clouds on the horizon. Whether they dissipate or gather is still, pardon the pun, up in the air. We just need to make sure we're watching very carefully, because while there certainly is no virtue in acting too late, there's also no virtue in acting too soon. Against this backdrop, the responsible play is to watch the hard data as they come in, along with the soft data we glean from our contacts, listening to the story they're telling us, and then acting accordingly to the moment. Now, I only have 3 more FOMC meetings to attend before my retirement, but this is the playbook I will be following. Between our January meeting and the next FOMC meeting in March, we will have received 2 additional CPI and PCE readings, along with 2 months' worth of employment reporting. That allows us ample time to read deep into a whole lot of data, and that's a good thing. In this work, we disengage from hypotheticals, and we need to focus on realities. It's easy to play the hypothetical game, but we need to focus on what is facing us in the hard realities. The more data points we have, the better these realities come into focus. Our actions, let alone our public pronouncements, cannot be based on conjecture. They have to be based on fact. And by us, I do not mean those of us sitting around the FOMC conference table, but I really include all of us here. So I want to thank you. I want to thank you for allowing me these few moments. And Bill, I think we're going to have a conversation.
As as Bill comes to moderate our Q&A, let me just correct that I should have allowed him to bring a welcome. So, William Kennedy, who is the CIO RiskBridge Advisors and GIC Board Chair Emeritus. Welcome.
Good morning. So protocol has been said. Let me just jump to the punchline. Thank you. Thank you for being here. Thank you for a very warm reception, our second year in a row. We weren't sure if we were going to be invited back, Mr. Lang, but thank you. But we are very, very grateful to the government of the Bahamas, the University of the Bahamas, President Hodder, Mr. Lang, for your very, very warm reception. So thank you very much. It's a pleasure to be here. So our protocol, we're going to take a few minutes to go through a Q&A. We will not be taking questions from the audience. However, President Harker will be available later during the break and also later this afternoon, and encourage you to corner you over a cup of coffee and get the rest of the story, as they say. So let me kick off with a question, President Harker. Just thinking about the Fed's mandate, the dual mandate between employment and stable pricing. You talked a little bit about where we are today, but when you look forward over the next 12 to 18 months, how do you think of that balance between the two?
So given the current policy environment we face, I think they're roughly in balance. I mean, inflation is slow to come down. Some of that's driven by shelter inflation. But we know in real-time rents, if you look at Zillow indices and other indices, those numbers are going to start coming down as well. I think we're going to talk about mortgage rates and the 10-year rate in a little bit, but that is the one thing that's propping up that cost. Also, that insurance premium I just talked about is when you wrap that into your mortgage payment, your monthly mortgage payment, it's pretty substantial. I mean, some of the increases that people are seeing are quite large. And what we're seeing is in certain markets, insurers are just simply pulling out. They're not even underwriting insurance. So that has become a real challenge when it comes to shelter broadly. Um, so I do think we are moving slowly down. That's our base case. But as I said, there are risks there. And again, there are changes in policy, domestic and international, that could have a significant impact on inflation. But at this point, we don't really know what those are. I mean, honestly, there's a lot of speculation about what those policies might be and what the impacts might be, but they're not finalized. So we just simply can't speculate on what might happen. Uh, Labor market, again, looks pretty solid. I mean, if we, this is where, as I said, people saying, oh, the labor market's slow. Not historically, it looks pretty good. I mean, again, there are some signs and there are some issues, and we can talk about those as well. But I think things are pretty much, they're in balance right now. That's going to be subject to a lot of change if policy changes, right? And we'll just have to act accordingly.
So my video game. You had a great comment about the only certainty is uncertainty.
Yeah.
As a policymaker, or for the FOMC in general, just take us in the room, help us understand in a world of greater uncertainty, how is policy made? How do you get to balancing fact, opinion, narrative, and expectation?
That's a good question. So again, I can only speak for myself, but I tell you what we learned. I think when the pandemic hit, we were scurrying to get more real-time data, right? Just data that could give us a sense of what's happening on the ground right now. The survey I just mentioned that we launched in Philadelphia, the Consumer Finance Institute survey, called the Life Survey. This is a much higher frequency survey. We started this in the pandemic just to see how households were coping. And now we've made this a regular part of what we're doing. What we learned out of all that, whether it was getting Google data on commuting patterns, restaurant, open table reservations, whatever it was, bringing massive amounts of other data other than the traditional things we would look at, right, in terms of unemployment and inflation indices. That hasn't gone away. So now I think we're more accustomed to using a wide array of data. And some of that as well, and I wrote a little opinion piece a few months ago on our website about this, is the use of soft data. Because the data we have is backward looking, almost always, right? The hard data. You also have to look at survey data, other information, like for example, we started to hear from our contacts early on that inflation was not just about used cars and a couple of other categories. And so I started to be an advocate early on about we needed to start bringing the policy rate up sooner than I think others had. And some of that was based on, because the hard data wasn't telling you that. But if you listened to people, if you listened, whether it was survey work, just one of the beauties of the Fed and our structure of 12 reserve banks scattered across the country is I get to spend a lot of time in my district sitting down, meeting with business leaders, nonprofit leaders, government leaders in small towns, large cities. And you get it, after a while, you get a pretty good sense, a pulse of what they're facing. Bob Solo's old comment, the economist, the plural of anecdote is not data. I get that. But if you hear lots and lots and more and more and more and more and more stories, you start to get a sense that, yeah, no, this isn't just about used cars. So I think what we need to do, and I think we've gotten better at this as a system, is integrating all that data together. No, I think there are actually opportunities, research opportunities here for the profession, the economics profession, to create more formal methods of how to integrate that data, right, through machine learning and AI techniques. So I think there's a real opportunity to, and some people are pursuing this right now, and people are giving it a shot. But that is an area that that we learned in the pandemic, that we need to keep pressing that pedal of getting as much data as we can, soft and hard.
And given the data that you've seen, I think you alluded to it in your prepared remarks. Are you more hawk? We know you're 100% eagle,
I'm
but
100%
are you
eagle,
more
that's right.
hawk or more dove at this point?
I am an avowed radical pragmatist. I I think that in this role, you really have. So the media, I'll use the media. They've put me in the camp of a dove. They put me in the camp of a hawk. You know, I'm actually comfortable with that because I just try to call it like I see it and look at the data and just make a decision based on that and not come into it with a certain ideology. Because I just think that, I mean, that rarely plays out the way you think it is if you're going to be an ideologue about it. So I try not to do that.
Thank you. So one of the important tools at the Fed's disposal is the balance sheet.
Yeah.
There's a question of the size.
Yep.
There's a question of the mix and the rate of change in both. Can you just speak to particularly the reserves, the bank reserves that reside on the Fed balance sheet, path forward, and what's the current thinking about the use of the balance sheet as a policy tool?
So again, these are my own views. I think we need to move to an all treasury or mainly treasury portfolio. I think that's a general consensus that we need to start moving in that direction. How we do that is up for debate, but I think we're moving in that general direction. Then there's a question of the composition and maturity, where we are on the curve. That again is an active area of debate. I mean, do we reflect what's available in the market? You know, we don't know that. That's something we have not decided. So I think in terms of the composition, that's where we're heading. And there's still lots to be decided there. In terms of the size, so we've seen the ONRRP, the overnight reverse repo facility, that's come down. How much lower it will go, again, that's something we don't exactly know, but we've drained a lot out of that facility right now. And so now we'll start to see the reserves actually change more significantly as a result of that. And we've made it clear in our monetary policy framework, we want an ample reserves regime. What is ample? It's the Goldilocks, right? Not too much, not too little. It's just about right. I mean, we have enough so that, because we've really switched, right? We don't actively trade in the Fed funds market to administer our rates. We administer rates with administrative rates, right? The reserves, the interest on reserves, the ONRRP rate, and so forth. We created this new system. So we need to stay away from the kink in the demand curve for reserve. That's the plan. Where that is, we don't exactly know. We have estimates, but I go back to 2019 and our aborted attempt, because the world changed on us, to start moving reserves down. At that point, we thought we knew where it was, but the estimates, I remember our staff, we had a certain estimate. We thought, yeah, that seems too high. So let's just cut it down a little bit because it just seemed too high. Well, it ended up our initial forecast of where it was exactly right. That in that instance. So, and we were at the very high end of where we thought it would be. That's why we thought, yeah, we're an outlier, way too far out there. But it ended up being right. We'll know it when we see it. I mean, where this ends. And we're monitoring a wide array of liquidity measures to measure, to see how the markets are reacting. Because the last time, when the market started to get really choppy, we knew we hit that point, right? Here, we don't want to get up to there, so we're monitoring a whole spider graph of measures that are trying to forecast when we're at that point where we've reached the ample reserve regime. My view was we're not there yet, but that doesn't mean we're not soon approaching it. We just don't know. We just have to keep our eyes and ears open.
Thank you for that. So in September, the Fed launched a rate cutting cycle.
Yep.
And we had a very unique situation where the Fed funds rate came down, but the 10-year yield, the nominal yield on the 10-year Treasury rose and it continues to trend higher.
Yeah.
Can you talk about that dynamic and what challenge has a rising 10-year yield presented to the Fed to implement monetary policy?
Well, again, we were just talking about the cost of home ownership right there, right? Just look at mortgage rates. I mean, there's an example, and you can multiply that across the economy, right? Of that having the effect, not the effect we want. Why is this happening? Well, I mean, to give you the technical answer, it's about premia, term, and interest, right? Premia.
Term premium being embedded in the nominal yield, one of the component parts.
And so, and mechanically, what is the term premium? It's the residual after you factor everything else in, right? So, in other words, we don't really know. I mean, the honest answer is, in my view, this is the engineer hat in me, right? We don't really know what that is because it's just the residual term in that equation. Yeah, but why is that? I step way back and go to economic 101 principles, supply and demand. Like any good, it's supply and demand. And if you have fewer people that want something, but I'm putting more supply in the market, the price goes down, and subsequently the rate goes up. That's the dynamic, and there's a series of factors that are driving that. There's both the issuance from the U.S. Treasury, new issuance that's bringing this to market, and there's potentially changes in the demand side of it. Who wants it, right? Ultimately, that's what's driving this. There's a lot of debate within the profession about exactly how can you parse out underneath the hood of those two factors what's going on. We're pretty clear on the supply side. It's the demand side, which is, we're functioning in a global market. It has decoupled the Fed funds rate, the overnight rate, from the 10-year, in a pretty significant way. So it's an area of active research and trying to understand this, but it's clearly embedded in those premiums.
So I want to go back just a moment to the reserve comment and the management of the reserves. That obviously is going to have some knock-on effect to the banking system.
Sure.
Nationally, but certainly the regional and local level as well. Maybe just for your district, can you speak to the health of the banking system, both for the you have many big regional banks in your district.
One in particular, yeah.
And then a number of community banks and smaller banks. What's the health of the system? How do you think the reserve adjustment might impact the banking system?
So right now, what we're hearing from, and we spend a lot of time talking to banking contacts, we're not hearing any significant concern about that at this point. I mean, they feel like they can manage it, would be the way I'd put it. Again, because I don't think, while we don't know exactly where that level is, it's probably not some dramatic change from where we are now. Right? It's change, but I don't think it's some dramatic change. So I'm just not hearing this is a big concern from our contacts. There are other concerns they have, significant concerns. That's not on the top of their list. In the case of community banks in particular, because we are like Kansas City, the Kansas City region, lots of community banks. They are really struggling with how to keep up with technology and how to create innovative partnerships that with fintechs and others that can help provide what customers want in a way that doesn't cost them an arm and a leg to do it. They also understand the risks involved in that. I mean, one of the risks that we're very focused on from a supervisory point of view is third-party risk, vendor risk. And we've seen instances now of where institutions have not managed that well with one of their vendors, and it didn't turn out well, right? So that's something we need to stay focused on. But every year in the Philly Fed, we've now done this for 8 years. We put on a big fintech conference in the Philly Fed. Ours is unique in that it's both industry participants plus senior regulators come together, and basically, in some cases it gets, as one person put it this year, the conversation got a little spicy. Uh, and that was a good thing. I mean, people were really arguing the way they should in that kind of venue about a variety of issues. So fintechs are one area that they are really looking at it. The second area that you see is the consolidation in the industry. Some of that is scale. They need scale to produce. The other thing, though, that is particularly, I hear this all the time, is management succession. That people aren't going into the banking sector like they used to, and that they can't find people to take over. And the management's aging, and so they'd rather just sell to be able to get scale, and also have a better management succession plan. I, you know, that's a real risk as well if you don't have the talent in the industry. And I'm worried about that too, because you look at, my old employer. I used to be dean of the work school. We were a major supplier in financial services of talent. Now until recently, they were all going into tech. They were not going into financial services and banking. And the sector needs that talent. I mean, we think it's always going to be there. It isn't always going to be there. And what happens with those community banks is who loses in this are those communities where there's no bank anymore, or maybe there's a branch that's not the same as it once was, where the bankers in the community knew the community, were investing in the community. That's what I'm hearing more than worried about reserves at this point. And also lots of other things around regulation, and especially on BSA and anti-money laundering. We're hearing that as well. Because there again is talent. People are desperately looking for BSA talent, Bank Secrecy Act talent. And in some cases, they're even doing innovative things like sharing somebody if you're a smaller bank, just because the talent is pretty thin.
So not a prediction, but you could draw a logical conclusion that in the U.S. we're likely to see fewer banks.
Well, that's been going on for a while. The trend has been going on
that
for
trend
quite
will
a while.
continue.
Yeah, I don't see that, but I do worry about these smaller communities I visit where the bank invests tremendously in their local community, and we know that when there are mergers and so forth, some of that goes away. It's natural, right? It's human nature.
So President Harker, you talked about fintech and innovation in the financial area. One of the areas that is a focus of this conference, and it's been a focus of GIC programs now for some time, has been around digital currency.
Yeah.
We are in the ground zero of the sand dollar. We're in the home of the sand dollar.
Right.
Share with us a little bit about from what the Fed is doing with regard to central bank digital currency, the research that's taken place, and the direction going forward.
So I'll just cite Chair Powell's comments last week in Congress, in his testimony in Congress. We are not, at this point, entertaining the idea of creating a Fed central bank digital currency. That's not on the table. He made that very clear in Congress. That said, we continue to research it, just to understand in the event. And the other thing he said repeatedly, which I agree with, we wouldn't do it unless Congress authorizes us to do it. We would not do it on our own. And so, we continue to do the research just to make sure if in the event Congress did want us to do it, we'd be ready. But at this point, I just don't see that in the cards. It's just not something that's we're not. So we'll continue to pursue research, particularly some of our economists looking at market structure relative to what would happen, who would be the winners and losers, and a lot of this gets down to the devil's in the detail of exactly what it would look like in terms of who's going to be the winner and loser, say in the financial services industry. That's good research just to have handy, so we know. But at this point, no, we're not thinking about in any way, shape, or form implementing a central bank digital currency.
So 2 last questions. I'd like to go back to the labor market for just a moment. Structural changes that are impacting job participation, the labor participation rate. Can you just speak to that for a moment? What structurally is shifting within the U.S. labor market?
We're getting older.
You heard it here first.
No, I'm a baby boomer. We, the baby boomer generation in America, are the largest generation to go into retirement. And we are. Right? And that has had a profound impact on the labor market. I mean, profound, and it will continue to. It has a profound impact on a variety of things. We're also the largest generation to transfer wealth to the next generation, right? So we're going to see a lot of shifts due to the demographics that we're facing. So what do we do about that? Well, again, there's a basic economic rule, right? That there's not a lot of things you can say there's a law in economics, like a physics law. But one is pretty simple because it's an identity equation. I'm simplifying it, but growth, if you want growth, is either you get more per worker, i.e. productivity, or you get more workers. Right? They're the 2 things you can do in a very fundamental level. So we are seeing an uptick right now in productivity. Whether that's sustained or not is too early to tell. But that we are starting to see some uptick. The number of workers, well, again, without getting into policy, I'm not going to get into policy that's not in my wheelhouse. But how do you get more workers? Either bring more workers in the market, and there's a couple ways of doing that. Bring people from outside the U.S. or have more babies. And we know in all developed economies where that's going, the latter issue, that our birth rates are in decline, and we're not replacing ourselves. Or this is, I think, an area that I do think we've really focused on, in particular in research at the Philly Fed. Bring more people off the sideline to get the skills they need to be productive in the society, in the economy. So where do you get those people? Well, again, you can focus on things like immigration or birth rates, and there are countries that are doing that, right, around the world. Or you see the people who are not reaching their potential, their economic potential, their human capital potential, and get them off the sidelines and into the workforce. This is an area that we've actually pioneered in the Philly Fed, along with the Cleveland Fed and sometimes with the Atlanta Fed, on what we call opportunity occupations. What do we define as an opportunity occupation? It's a job that does not require a 4-year college degree, where you can get paid above median wages. So these are life-sustaining, family-sustaining, middle-class jobs. We know, and we have a data set now over multiple years in regions all across the country where we know what those jobs are and what the average increase in salary would be if you went for that job. In fact, we have a tool called the Occupational Mobility Explorer that you can go on our website and look at. You can go into a region like the Philly region and say, this is what I currently do. This is what I currently do. With a little bit of certification, what could I do next? So what would be the increase in salary? And then it allows you to actually play the 2 more hands. And if I did that, what could I do next? And if I did that, what I could do next? A good example, a simple example, say you're an administrative assistant. With a little training, you could be a medical secretary. And the increase in salary is pretty significant. And this is blue collar jobs, white collar jobs, that we need people to get those skills. What you hear, we heard this during the recovery from the pandemic, but it's still out there. The job market, I mean, forget the pandemic, go back to 2018, 2019. What was the biggest complaint we were hearing from employers? They couldn't find the people they needed. What are we hearing today? They can't find the people they need. And particularly you think about what we're trying to do. I think about this a lot. This is, again, I'll put the engineer cap on me. Think about what we're trying to do in the United States in building out lots of new infrastructure, lots of new industries, manufacturing. There's not the people that know how to run those machines, to maintain those machines, to build this technology. And so we need a whole focus on training. And again, for some people that involves a 4-year college degree. I'm a former university president, so I love higher education. I love universities. But not everybody in our societies needs to go get a 4-year college degree. People can be successful, or right away. We also have to stop thinking of it as if you don't get your 4-year college degree after high school, your life is over. That's not true, right? And so lifelong learning is really a critically important part of this as well. So I think that is I can't deal with the other part of the demographic challenge, right? That's not what we do. But I can do the research that lays out how do we get more people in the workforce. This is an area that I'm really proud of that we do at the Fed that often gets overlooked is our community development work. This all came out of working with low, moderate income communities and understanding the challenges they face, but also the opportunities that are there. And that's why we're doing this work. We want to put this tool in people's hands so that they can make informed decisions about their futures. Because if they make better decisions with the information they have, the economy benefits as well.
Thank you so much. Final question. So for a decade, you have been a public servant with distinction. Thank you very much. When you look back over your 10-year experience with the Federal Reserve Bank of Philadelphia, what has surprised you the most? What did you learn along the way, and what's the one thing you're taking with you?
So one thing I've learned, and Madam President I think you would resonate with this. Imagine a university where there's no president, there's no provost, they're just deans. Yeah, you're cringing. And they have to get together and collectively decide on things and work together to build the university. That's a challenge. The Fed has somewhat of that challenge. The one thing I didn't understand coming in is people ask me, do you often see your colleagues, the other presidents? I see at least one of them every day because we run as a collective. The 12 Reserve Bank presidents, the 12 Reserve Bank's first vice presidents, the chief operating officers, we increasingly are running things across the Federal Reserve System, not just in Philadelphia or in San Francisco. So I spend an enormous amount of time, and as you get older in this job, I'm not sure wiser, but let's call it older, they give you more responsibility. So I chair the committee that oversees our information technology. This is a very, very large, it's about a third of the Fed employees are involved in this. So it's a very large financial and human capital investment that we're making in running the payment systems in the country, our own internal systems, the security of those systems. That I didn't understand how important that basic infrastructure is that we run. And I think the American public doesn't always see it. They see the interest rate. But most of what we spend our time doing is not sitting around and contemplating the Fed funds rate. We do contemplate it every 6 weeks, roughly, 8 times a year. But the rest of the time, we're running the system. And we're running a very large, complex bank. We're a bank to banks, and we're the federal government's bank. We're the fiscal agent for the U.S. government. That I didn't understand, just how critical that is. Second thing is I didn't understand the depth of our community development outreach. This is really important in Philadelphia. So if you know anything about Philadelphia, Philadelphia is the poorest major city in America. Of the top 10 cities in America, we have the highest poverty rate and the highest deep poverty rate. So, unfortunately, in some ways, we've built expertise over a long time on what works and what doesn't work in moving the economic needle for low, moderate income communities. And that work has been very impactful. We have a program called the Economic Mobility Project, EGMP, Economic Growth and Mobility Project. And we have a major conference, by the way, coming up in April on social mobility, economic mobility. That's going to highlight a lot of the work we do, not just in Philly, but across the system. Because again, if we don't get people into the economy in a productive way, we all suck. And so this is, people ask us, why do we do this work? I think it's straight up in our dual mandate. I mean, if we want the economic growth we come to expect, we've got to solve this problem. We're not in the business of solving the problem. We're not going to create the training programs. We're not going to do all that. But we can lay out the facts about what works, what doesn't. We can lay out the facts about the economic impact that putting these programs together would have. The other thing I'd say about the region, and then regionally, what I didn't understand, I kind of understood, was how critical the anchor institutions are. What's an anchor institution? Eds and meds, higher ed, and healthcare. This is an area that when the pandemic hit, we didn't fully understand. We always thought this industry was recession proof, right? It's always going, well, guess what? It's not. What we're seeing right now is a massive shift in higher education because of the demographic shift in the country. And this is leaving some communities high and dry in my district. And I didn't understand the sort of depth of this change that's happening. So we have a whole initiative called the Anchor Economy Initiative, where we have data on 524 regions in the US on the economic impact of eds and meds in those regions. Take Philadelphia. Philadelphia's reliance score is a 1.4. That is, it's 40% higher than the national average. We are highly reliant on our eds and meds. If they're healthy, we're healthy. If they're not healthy, we're not healthy. That is, again, an area I didn't quite understand coming into the job about how much we didn't know about this sector. It's a messy sector. It's government funded often and the private sector, but we're seeing this play out right now on some of the challenges that universities are facing in the United States with respect to, for example, NIH funding and the concerns there. This is big money in these cities where there's lots of research going on. So that's an area that I think we've tried to build some infrastructure to understand it. In a way, back in 2018, we just didn't have that infrastructure in place to fully grasp how important this sector is and the rapid changes it's going through right now. So if you're interested, I encourage you to look at the Anchor Economy Initiative.
Please join me in thanking President Harker.
You have 12 minutes for a coffee break. Well, before we start our next session. You have an opportunity to interact. And
Great.
Doctor.
Thanks.
Thank you so much. Appreciate it.